Hi, I'm Tim Ogden, Managing Director of the Financial Access Initiative at NYU Wagner. And I want to talk about the process of digitizing, specifically digital financial services, but digitizing small firms. Now, most of the conversation in the financial inclusion world for the last few years has focused primarily on person-to-person consumer adoption of digital financial services or bridging into digital financial services in retail payments. But small firms are a huge part of the economies of low-income neighborhoods and low-income people. And when we talk about bringing digital financial services and fulfilling their potential, we need to include small firms in that conversation. And understanding the needs of those small firms is really important to doing that. Let me give you a couple of examples. So let's take a baker in Kisumu, Kenya. Now, as we all know, Kenya is a real leader in the adoption of digital financial services. And this baker is banked. He has a bank account, he has mobile account, an M-Pesa account, and of course he still uses cash. And the way he uses those accounts is practically seamless at this point. He's able to move money digitally across accounts or into cash and back into digital fairly easily. So for instance, he gets payments from customers in cash and payments from customers via M-Pesa. By and large, what he does is he converts those payments into a cash account, and then as necessary, he moves cash back into his mobile wallet to make payments to raw material suppliers or others, employees that he needs to make payments to. It's a fairly simple model, and he wants to use M-Pesa because of the safety of it. He explicitly says that using M-Pesa protects him from theft of cash. And that's sort of an archetypal model of, well, obviously, it's good for the firms. They should want to move into digital financial services because there are these advantages and things are easy. But I want to tell you about another example that gives us a different perspective on what it means to bring digital financial services to small firms. This is a recycler, recycles plastic materials in Cali, Colombia. And again, he's highly banked, even more banked than this baker in Kisumu. He has multiple bank accounts. He has mobile accounts. He has cash accounts. And he does a variety of different things to meet the needs of the firm. So on any given moment, he's got money moving into and out of the firm from customers and suppliers, but also between accounts to accomplish his various needs. You can see that just in 1 week of transactions, there's cash coming in, there's bank transfers coming in, he's moving money between accounts, he's moving money into cash, he's moving cash into accounts. There's all sorts of things that he needs to do to manage that business and maintain the business in the way that he wants to. Understanding his needs and therefore designing digital financial services that meet those needs and are appealing to him is a much tougher problem than the simple example that we looked at earlier. Now, I want to take a step back and explain, where are these stories coming from? Why are we talking about this? And so these stories are coming from a project called the Small Firm Diaries. It's a global project to understand the needs of small firms in low-income neighborhoods in developing countries, covering from Colombia to Fiji. In each of 7 countries, we're studying more than 100 small firms, visiting them every 1 to 2 weeks, tracking all of their financial transactions so we can better understand what their needs are, both in terms of helping them grow, but also in helping them adopt and use digital financial services. So the firms that we're talking about are roughly an even split between light manufacturing, agri-processing, and services. We purposefully excluded retail because we think these industries are getting less attention and are really important for growth and helping people escape poverty. We also think it's important to understand the specific needs of women-led businesses. So about 1/3 of our sample is woman-led. We wanted to look at small firms, which we define as firms between 2 and 20 employees. Some of them are formal, most of them are at least partially formal. But they are still quite small. Their owners are probably not poor, but just a little bit above it. And their employees are often, by various measures, in poverty. Now, I do want to clarify that while our sample frame is 2 to 20 employees, most of the firms we're talking about are firms with 2, 3 employees at the lower end of that scale. So as we track these firms, as we're visiting them every week, we're paying attention to things like what accounts they use, what accounts they own and use. So we're tracking their various bank accounts, their mobile wallets, their cash accounts, their use of informal services like SACCOs or savings groups or deposit collectors. But we're also keeping track of the way they transact. So when they move money into or out of an account, how do they do that? Do they do that via banking agents or correspondence? Do they do that with direct bank-to-bank transfers? Do they use mobile apps from a bank? Do they use mobile wallets? Do they use cash? Because understanding the value proposition and the needs has to do with not only accounts, but the ways in which you transact between those accounts. And so what we see over time is that the usage of these accounts is still heavily in cash. Now, let me give you some context. From Findex data, we know, of course, that Kenya is well ahead of many of the other countries in terms of adoption of digital financial services. But for small firms and the kinds of transactions that we're talking about, even being well ahead means that roughly a third of transactions are via digital or mobile payments. And even fewer of those accounts are bank transfers using digital technologies. So with that as context, let's go back to talking about what we're seeing in the data across the firms that we're studying. If we look at the percent of firms that own accounts, unlike a lot of the conversation for the last 20 years of banking the unbanked, these small firms are banked. They're using formal accounts. Well over 60% of them, in some cases nearly 100% of them, have accounts in formal institutions, be those banks or mobile wallets, regulated financial institutions. Of course, many of them are also still using informal accounts, cash boxes, and a variety of other tools. But as we know from what we've learned in the last few years, is account ownership and usage are different things. So although these firms are banked, a large portion of the transactions are still using cash accounts. And by cash accounts, I don't mean a checking account or a current account. I mean a cash box, a till, an envelope, a box under the mattress. Money that's literally stored in cash outside of the formal financial system. If we further go and look at the way they transact, we see that the transactions are still heavily, predominantly in cash. So even if they have a bank account and they're making use of the money from the bank account, what they're doing by and large is getting cash from the bank and using the cash itself to transact. There's still a long way to go to get these firms to digitize. So what is it going to take to get them to adopt digital financial services and use those digital financial services and reduce the use of cash? Let's go back to some of our examples. So I mentioned the recycler in Kali, and you saw this complicated transactions that he has. So what you'll see here is these accounts, again, this is just 1 week of transfers within this relatively small firm, that include payments into his accounts, receiving cash and or bank transfers, or payments out of those accounts to suppliers, to employees. And again, using both cash and bank transfers to do so. You'll see that he's using basically every mode of transaction to accomplish those goals. Let's talk about another kind of firm, a shoe repairman, a leather worker in Lagos, Nigeria. This firm, again, banked, uses a variety of financial services and presents an interesting case. When we visited this firm, one of the things we noticed right away was that he had printouts with his bank account for transfers for 2 different accounts. And he had customers pay different accounts at different times of the month in order to manage his flow of funds and make sure he had funds in the right places. But even still, he's primarily using cash. He's using cash to pay employees, because his employees prefer receiving cash. In fact, when he has tried to use digital financial services, he's encountered some security issues that the money didn't arrive, or the employee was not able to access the funds that were sent that way. The transaction accounts and modes that this leather worker uses are largely driven by the preferences of the people he's interacting with. So if a customer wants to pay with a mobile app, he accepts the mobile app payment. If they want to pay in cash, he accepts the cash payment. And as I mentioned, he's still mostly paying his employees in cash because his employees prefer the cash. And there's not enough reason for him to push them into receiving digital payments. Let's take a look at another firm. This is a woman who operates an embossing, sort of stamp making business in Bogota, Colombia. Now, visiting this woman was particularly fascinating to me because she runs a fairly sophisticated business in terms of the machinery that she has and the things that she's able to produce. Very high quality stuff. But she prefers dealing in cash. In fact, when I asked her about her use of accounts, she said, well, yes, I have to accept digital payments now because some of my customers demand it. But I want the money in cash. I want it in cash because it's much easier for me to keep track of. And she showed me the drawer that she uses with envelopes, the classic envelope method. And she says it's much easier for her to run her business in cash and with her drawer because he can just look in the drawer and see the sizes of the envelopes. A couple of times a day helps her be comfortable that she's got the money in the right places to accomplish what she needs. And you'll see that interestingly, against what we might expect, not only does she use cash for most of her transactions, but the average size of those transactions is larger in cash than it is in her bank transfer or mobile transfers. So what can we conclude from this? It's easy to say it's complicated. And in fact, it's complicated. Getting small firms to adopt digital financial services, use mobile accounts, use digital modes of transaction is complicated. But of course, we need to know more than it's complicated. And I think there are a few things we can take away from these examples and what we're learning from the Small Firm Diaries. First, I think it's important to remember that adoption takes time. We shouldn't be thinking of the fact that they have accounts and are not necessarily using them that much as failure or as completely disappointing. The first step is adoption, and it comes before usage. And if we look at the history of usage in economies where there are much more digital forms of transaction, these things did not happen overnight. And even still in today's terms, many small firms in developed countries prefer to use cash. Many consumers still prefer to use cash for their transactions. We need to have realistic expectations about the pace of adoption and usage, and where we're going to get in those measures. We're also seeing that in many of these economies, the digital financial services ecosystem is rapidly advancing. And as a consequence, there's more and more reasons for people to use digital financial services. We shouldn't expect wholesale adoption very quickly as the ecosystems continue to build out. Remember our most successful example in Kenya, we're still a long way from even half of transactions moving into digital. When we think about the ways that firms move into digital, it remains important to think about both push factors and pull factors. And in our conversations with the small firms, we think of those as push factors are when a customer wants to use digital, and a pull factor is when a supplier demands payment in digital. And both of these are playing a role in getting the firms to use more digital forms of account and forms of transaction. That's a dimension of increasing digital adoption that we can't neglect. Second, I think we really need to think through some of our value propositions that we think are appealing to small firms. So just to give you two examples, security and record keeping. Now, it seems obvious that digital modes are really useful from a security and record-keeping perspective. But as we talk to these firms, we see that's not always the case. In fact, raising security as a value proposition can backfire, because many of the firms do have experiences of fraud or misdirected funds and bad experiences of dispute resolution with digital forms of account and digital forms of transactions. Many of them perceive cash as more secure than digital financial services. There's still work to be done to make sure that our digital ecosystem is secure, that customers, both individuals and firms, are protected from fraudulent activity, know how to recognize fraudulent activity, and fully trust that when they make those payments, make those transfers, that what they expect to happen is going to happen. Record keeping, I mentioned a moment ago, is another example. And I think again to this woman in Bogota, Colombia. We tend to think of a digital transaction trail as a big step forward in record keeping. But I don't know about you. As I was talking to this woman in Bogota, I was reflecting on my use of a couple of the digital aggregators that were quite popular over the last few years, that bring all of your accounts into one single view. And I know that that got actually so complicated that I never look at them anymore. And as I talked to this woman in Bogota, I got that sense too, that the physical manifestations of cash can in fact make record keeping much simpler for firms that aren't using a whole lot of other digital tools in the rest of their lives to keep track of things. There's still a lot of work to be done to understand those use cases and how digital can enhance record keeping and not just create another stream of information that's hard for overwhelmed firm owners to keep track of. So what can we conclude from all of this? What are the takeaways? As I said at the beginning, it's more than just it's complicated. So let me walk you through the ways that I've been thinking about this. First, as I mentioned, we always have to keep in mind that adoption takes time, and it takes longer for small firms. Small firms in the United States have had a much slower adoption track to things like credit card acceptance than consumers have. Second, small firms' liquidity flows and account usage is by and large vastly more complicated than it is for consumers. We have to really understand those account usages and the ways that small firms are using accounts and transacting to develop better use cases. Third, we shouldn't neglect the push and pull factors. There are relatively few rapid adapters, firms that are going to just, because of their own needs, adopt digital financial services and then be pushers out to others. They have a lot on their minds. They've got to keep a track of a lot. They're not out there sort of reconfiguring their financial flows on a daily basis. So the push and pull factors, consumers demanding the ability to pay digitally, suppliers demanding being paid digitally, that are going to be an important part of those use cases. And finally, we can't assume that the value propositions for consumers, or even in other economies or other situations, apply to small firms, or even that they apply to all small firms. Some of those use cases that may appeal to one small firm may in fact be a negative for another. Thinking through, what is it in terms of security, in terms of record keeping, in terms of ease of use, in terms of cost, in terms of being able to transact at a distance, makes sense to which firms, and designing products and the sales and marketing of those digital financial services is going to be a key part of the solution to helping small firms digitize. I hope this was useful and interesting for you as you think about digitizing small firms. There's a lot more to come from the Small Firm Diaries. So please take a visit to smallfirmdiaries.org and sign up for our updates so you can keep track of new research that's coming from our work with these small firms across the world.